All right, tech lovers, hold on to your circuits because Synopsys has been making waves on the NASDAQ today, and not in the way most investors would like. If you've been tracking SNPs, you're aware that they've hit a bit of a road bump recently, down nearly 20% from their 52-week high. To start, Synopsys shares have taken a nosedive of 16.9% over the last 3 months, definitely underperforming both the Zacks computer and technology sector, which dipped only 1.1%, and the Zacks computer software industry, which decreased 2.7%. Ouch, so why the fall? There's a cocktail of issues here. Key among them is the rising cost of revenues and operating expenses. For instance, in the third quarter of fiscal 2024, Synopsys saw expenses balloon to $1.17 billion from last year's $1.01 billion. Alongside this, they're wrestling with stiff competition in the semiconductor and electronic design automation industry's ring. Let's just say it's not easy to stay on top when you're sparring with heavyweights like Cadence Design Systems and Mentor Graphics. It's not all gloom and doom, though. In the third quarter of fiscal 2024, Synopsys reported a 13% uptick in revenues, hitting $1.53 billion. Looking forward, they're aiming for approximate 15% revenue growth for fiscal 2024. Optimistic? Sure. But they've set the bar high with projected revenues nestled between $6.105 billion and $6.135 billion. For those of you who enjoy the nitty-gritty details, their non-GAAP earnings are forecasted to be between $13.07 and $13.12 per share. All right, let's get real. Despite these somewhat optimistic forecasts, Synopsys' design automation segment saw a slowdown, only growing 6% year over year in the latest quarter. Contrast that with last year's 23% boom in the same quarter, and you start to see the challenge. Yet there's always a silver lining, right? Synopsys is in the midst of acquiring ANSYS, hoping to boost its silicon-to-systems strategy. Think sectors like automotive, aerospace, and industrial. This move aims not just to diversify, but to magnify their customer base and product portfolio. And hey, acquiring over 15 companies, including Intrinsic ID and Valtrix, over the past 5 years suggests they're playing the long game to broaden their market horizons. Still, if you think now's the time to swoop in and scoop up some shares on the dip, hold your horses. Synopsys carries a Zacks Rank number 3, suggesting it might be wiser to wait for a more favorable entry point. And let's not glaze over the valuation. Currently, they're trading at a forward price earnings of 34.82x, higher than the broader sector's 32.33x. That's like paying craft beer prices for a domestic lager. Meanwhile, if you're hunting for greener pastures, Progress Software is sitting pretty with a Zacks Rank number 1 and has appreciated 23.2% year to date. So keep an eye on the landscape and test the waters before making your investment plunge. And that's the latest on Synopsys. Rising costs, strategic acquisitions, and a bit of a bumpy ride on the stock market. Here's hoping their innovative product lineup and market expansion strategies turn this narrative into a redemption story. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.